Welcome to our financial management course. Today we are going to talk about one of the most important ideas in all of finance, risk and return. Now, you might think this is just another definition you need to memorize, but it's not. This is something you will experience in your own life, every time you make a financial decision. So instead of starting with formulas or theory, I want you to imagine a situation. Imagine that someone gives you $1,000 today. No strings attached. It's yours. Now the question is, what do you do with it? Do you protect it? Do you grow it? Do you take a chance? That decision is exactly what today's lecture is about. Let's walk through your options. You could take that $1,000 and put it in a savings account. It's safe, very safe. You know it will still be there tomorrow, next week, next year. But something else is also true. It will barely grow. Maybe you earn a little interest, maybe a few dollars. Now let's consider a different option. You invest that same $1,000 in the stock market. Now things become uncertain. Maybe it grows to $1,100, $1,200, even more. But maybe it drops. Maybe it becomes $900. Maybe even less, at least in the short term. So now you are standing between two paths, certainty and possibility. Which one do you choose? There is no right answer, but your choice reveals something important about you. This brings us to the core idea. Every investment involves a trade-off between risk and return. Risk is the possibility that you may lose some or all of your money. Return is the reward you hope to earn for taking that risk. And here is one of the most important principles in finance. The higher the potential return, the higher the potential risk. If something promises high returns with no risk, you should be very skeptical. Because in real financial markets, risk and return are connected. Always. Let me introduce you to three investors. Rachel is very conservative. She doesn't like uncertainty. She invests her money in government bonds. Her returns are small, but predictable. She values peace of mind. Then there is Alex. Alex is aggressive. He invests heavily in stocks, especially fast-growing companies. Some years, he earns a lot. Other years, he sees big losses. But he accepts that volatility. And then there is Samantha. She takes a balanced approach. She invests part of her money in stocks and part in bonds. Her portfolio doesn't swing as wildly as Alex's, but it grows more than Rachel's. Three people, three strategies, all based on how much risk they are willing to take. Now here's something important. Risk is not just one thing. There are different types of risk. Sometimes the entire market declines. That's market risk. Sometimes prices rise over time and your money buys less than before. That's inflation risk. Sometimes interest rates change, and that affects bond values. Sometimes companies fail to pay their debts. That's credit risk. And sometimes you simply cannot sell your investment quickly without losing value. That's liquidity risk. So risk is not always obvious, but it is always there. Now let's come back to return. Return measures how much your investment grows or shrinks. If you invest $100 and it becomes $110, you earned a return. If you also received a dividend, that increases your return even more. But here's the key idea. Returns are not always positive. Sometimes your investment goes down. Sometimes you lose money. That is part of the experience of investing. And that is why risk matters. Now let's talk about how investors manage risk. First, time. In the short term, markets can move up and down unpredictably. But over longer periods, they tend to grow. Time allows investments to recover from short-term losses. Second, diversification. Instead of putting all your money in one investment, you spread it across many. Stocks, bonds, different industries, different regions. So if one investment performs poorly, others may balance it out. Diversification doesn't eliminate risk, but it reduces it. Let's go back to where we started. You have $1,000. But now, you see that decision differently. It's not just about where to put your money. It's about how much risk are you comfortable taking? What are your goals? How much time do you have? There is no single correct answer, only the answer that fits your situation. That is what financial management is really about. Understanding trade-offs, making informed decisions, and being aware of both risk and return. Thank you for being here today. I'll see you in the next lecture.